Good morning. Welcome to Tax Issues in the Cloud. This is Roger Royse, the founder of the Royse Law Firm, a business, tax, and corporate law firm with offices in San Francisco, Palo Alto, and Los Angeles. Today, we're going to have a discussion of the tax issues for companies engaged in cloud computing, including sales tax, state income tax nexus, value-added tax, and using offshore structures for income tax reduction. I'm here talking to my old friend David Wittrock, CPA. He's been a CPA and an attorney with over 34 years of experience in public accounting. He started when he was 5, apparently. He's currently the managing partner of a specialist CPA firm that advises corporations on tax matters and financial accounting. And I can tell you he has some very cool cloud company clients. They range from venture-funded startups to publicly traded companies. He advises executives and audit committees on tax strategy, tax management, and audit defense. So the objectives today for purposes, so two things, housekeeping. First of all, we are recording this webinar. It will be available for playback. The materials are generally available on our resource site, which is www.royseuniversity.com. We'll also have this webinar available as a podcast on iTunes, so you can listen to it and review the materials later. And on your screen, you should see the slides that Dave has put together, and we're basically going to follow these slides as we go through. You can ask questions in the comment box on the screen, and we'll gather those questions, and if we have time, hopefully we can respond to them at the end of the presentation. The objectives today will be to have a discussion about how to avoid any tax traps and surprises. And believe me, there are lots of traps and surprises. There's hardly an M&A deal or a financing that we do that we don't find some areas of non-compliance in taxation of cloud computing. We're going to have a general discussion to increase awareness of the range of the tax rules, which is surprisingly broad. Come up with a couple of fact patterns that we find are problematic, but of course we're not going to have all the answers to all the issues. Hopefully what we can do is give you rules and guidelines and spot some of the issues. So with that, I'm going to turn it over to Dave.
Thanks, Roger. If you take a look at what the definition of the cloud computing, just go to Wikipedia, you're going to see about 5 or 6 different types of companies. And today what we'd like to do is focus on the most common fact patterns. 2 of those are companies that actually provide server capacity in the cloud. You might think of Amazon Web Services, for example. And these companies are sometimes called IaaS, or infrastructure as a service companies. So they're on the service provider side. Probably more common are companies that buy these services. You might consider a company like Salesforce.com. And those companies are sometimes called SaaS companies, or software as a service, although the terms are used in various ways. And we're going to talk a little bit about the nature of these companies because that very much drives the tax consequences. Because the second type of company is more common, we're going to concentrate most of the comments on these companies, the users, but there are some issues unique to the web capacity or cloud computing providers as well. So we'll be mentioning those issues as we go along. So why does cloud computing cause these unique tax issues? And to boil it down to the obvious, there's technology services being provided, and software is a type of technology service, but it's not tied to the delivery of any tangible property. And the tax laws, of course, going way back to the turn of the century and the first property tax laws that were applied to railroads, were very much oriented towards where is something, where is a tangible object. So there's 3 basic factual questions that arise that can help one get through the myriad of tax issues. One, is there even a sale or a use? And these are 2 triggers or incidences of tax. Secondly, is there a tangible good, an item or a service or license of an intangible, or a combination of those 3. Finally, one of the most difficult questions to answer that arises from the first 2, where does the taxable event occur? And one of the fundamentals of tax that I think you're going to see permeating our discussion today is that the incidence of the tax is the event that triggers a tax in the first place, like making a sale or delivering an item or even engaging in business. A completely separate question is, how do you measure that tax? So there could be a tax on a sale of an item, and the measure of the tax is the gross sales price, but those two may not be very well connected because a lot of the value may have been added in a different location than where it's ultimately taxed. The tax laws have simply been lagging the new business methods. We're on slide 5 now. As I said earlier, the tax laws are triggered mostly by an identifiable event, an identifiable place. And if you go back to the early days of where I kind of cut my teeth in technology was in Microsoft in the early 80s, they were duplicating disks, first in Redmond and then in Ireland, and it was actually pretty easy stuff. We didn't know it at the time, but that was pretty easy to figure out. I mean, where did the disk go? And you could pretty much figure out where a destination tax applied and where was the software written and where was the disk duplicated. You could pretty well determine where the income was generated. Similarly with, say, consulting services, you can look at where the consultants are moving around and performing their services, although that's a little more difficult. Well, software, as you know, started to be delivered through various ways, including online delivery with a key, and then we went to application service provider models, ASP, and the tax disconnect began there because the software, of course, is not delivered in a tangible media, or maybe the software is not delivered at all, and that's where cloud computing comes in. You have to ask yourself whether an ASP type of service is a software license at all, or is it a service? And even defining ASP versus SaaS and where cloud computing fits in is very confusing to the technology people, not to mention to the tax folks. So there's been an evolution. It used to be Microsoft would ship out shrink-wrap software, and then it went to electronic delivery. Then we had ASP model like Oracle. You know, when you have the rights to use Oracle 7 or 8 or 9, whatever version they have now. Oracle hosted the software, but you had a dedicated copy of the software in the early days. And then they started moving to where you shared a copy of software and you didn't even have your own version. So there was further questions as to whether there was a license of software. Then you can move on to, say, the online payroll services, where the customer doesn't even use the software per se, but rather the user is sending in data, and the payroll service is using its own software, its own code base to provide a service. Well, cloud computing really is just the back-end IT system for all these types of means for delivering technology services and software services. Slide 7.
So Dave, you know, there's different ways that a company can access these data centers, and I suppose that probably affects the tax treatment.
Yeah, that's right. It used to be, back in the day when I was with an online music company, we leased blades, and we went to a colo, and we had a rack, and you know, we stuck our blades in there. So basically we leased the actual hardware, but we were provided space and power and so on. Then it evolved to a leasing of capacity, but it was still on a dedicated server, and we avoided the ownership and leasing issue, but we were nevertheless able to have dedicated capacity to the equipment. That has further evolved now to the point where taxpayers that are obtaining server capacity, let's say through Amazon, don't have any dedicated servers, and you don't even know where the servers are located. They could be dispersed. There's hot backups and cold backups and so on. This is sometimes called managed hosting, but again, you know, the terms are sometimes used interchangeably and for different concepts. So these different means that you as a user would get access to cloud computing services from the providers will to a large extent drive where you're taxable and the the characterization of the income and where you might have nexus and permanent establishment and so on.
So why don't we walk through a couple of fact scenarios and bring this down the abstraction level a little bit. So slide 8 describes one scenario where we have a SaaS company, A, which agrees with its customers to intercept emails, send them to its servers in the cloud, scrub them of spam, then send them back to the customer email servers for its employees to use. Let's suppose company A is in California. The customer is headquartered in New York and has employees in the U.S. and Europe, and the cloud data centers are in Texas, Illinois, and the U.K. So what we have here is essentially a B2B transaction. If you look at slide 9, you'll see a schematic that summarizes these facts. So Dave, how would we analyze this as a tax matter?
Well, we're going to be going through the state tax issues here and the international tax concerns that this company might have. Just glancing at this slide, you can see there could be multiple points of taxation. The company could be taxable at the company's headquarters in New York. Does it matter where the company's employees are that are using the services in the U.S. and Europe? Are there different standards overseas in the U.S. And in Europe? Does it matter where the data centers are? This is the cloud computing part of it, the upper right-hand corner, as well as a data center offshore. What impact does all this have? And that's what we're going to be going through in the next couple of slides. But to contrast that, let's take a look at another fact pattern, company B, and then we can compare the two as we go along.
Okay, slide number 10, company B is the other fact pattern that we might commonly see. And in this scenario, company B provides an online platform. In this case, it's for dinner guests to have a gourmet meal at the home of a host. It adds a service fee to the guest, keeps the fee, pays the host the balance. And we see there's a lot of permutations of this basic business model out there these days, and there's a whole non-tax regulatory regime that we're not going to talk about today. But for tax, let's assume that company B is in California, the consumers are in the U.S. and Europe, the cloud data centers are in Texas, Illinois, and the UK. So now we have essentially a B2C transaction.
And this is very important to distinguish between what we call a B2B transaction, the taxpayer being a business providing a service to another business, versus the taxpayer business providing a service to consumers, B2B versus B2C. Has a big impact in the sales and use tax in the U.S. It has an impact, at least insofar as the geography is concerned, in computing the VAT in Europe. Let's take a look at some of the tax concerns, as we mentioned earlier. Has the company exposed itself to tax and where the data centers are located? Where should the company report income from the services? You can see some of the possibilities here. We're on slide 12. In California, the customer headquarters, where the customer uses the services, if we can even determine that. Where the servers are, if we know where they are. And also, how is the income to be characterized? Is it like a license fee, or is it a pure service? License fees could attract sales taxes in the U.S. Generally, pure services are not subject to sales tax in the U.S. There are some exceptions to that. When you get in the international arena, license fees versus services income have a number of different characteristics. Both of them attract foreign income taxes and some gross receipts taxes or withholding taxes on cross-border payments. The value-added taxes apply probably at different rates because there would be a different location where the service or license is deemed to be provided. And there's varying rules depending on how you characterize the income. Let's start with state income tax. That's a fairly easy one. The first question is whether Company A and Company B have created a taxable nexus or taxability in states when they're using servers there. And generally speaking, engaging in a contract with a service provider that is giving you server space would not normally create nexus, but it can, particularly if you're in that model of actually leasing the servers or have some sort of direct ownership or responsibility over the physical equipment.
So Dave, can I interrupt? Now, I understand that some states take much different views as to whether accessing a server in our state is actually a lease or whether you're just actually accessing the information. So you might get different results in different states on the exact same fact scenario.
Yeah, that's right. And what you're going to find is that you get local jurisdictions sometimes in these states. There's city taxes and there's county taxes, and sometimes you have jurisdictions that are not as sophisticated as others. So you can end up trying to educate these people, and they're pretty resolute because they look at the form of the transaction generally, and then they try to expand from there and find anything they can hang their hat on to apply the tax, of course.
But as a general rule, I guess we could say that merely having a third-party cloud-based service provider in a state is not likely nexus for state income tax. Leasing the servers probably is.
Yeah, that's correct. I mean, that's the position I take, and it's a practical position. You have to take a look at whether you want to affirmatively file in some of these states. If the company is running losses now, you may actually affirmatively want to go ahead and file income tax returns in states and admit that you have nexus in order to build up loss carryovers. So it's a very practical art form here to decide where you should be filing. And there's a number of other considerations aside from just the technical one. Okay, so the other aspect here is the second bullet on slide 13, and that is assuming that one does have nexus in a state, is income going to be sourced there merely because you have a data center? And income for state purposes is apportioned under formulas based on where the income is generated. Some states use the location where the servers are located because there's a standard set of regulations called the UDITPA regulations for sourcing income, and they look to where the cost is incurred, oftentimes for service-type businesses, which would be the case for our Company A and Company B. There are 14 states now that source income to where the customer is located, and that actually can be determined by going to the URL, and in those cases the location of the server is not going to attract income, but rather the recognition of the income for state income tax purposes is going to be dispersed around to where the customers are located. And states are moving more and more towards sourcing income to where the customer is located. That's called market-based sourcing. So the location of the servers may increase your income tax in a state, but an increasing number of states are looking through that to where the ultimate users are located. And think back to Company A and Company B. Company A is a B2B company, and it may seem that it's easier for them to determine where their customer is located because Company B's got a headquarters. Its customer has a Company A's customer has a headquarters location, and that can be determined. However, Company A's customers have employees all over the U.S. using this service, so where is the benefit being received? That's a bit of an issue in terms of sourcing the income. Okay, so let's go to sales tax, slide 14. The same nexus question arises here. There's a different nexus standard for sales tax to apply than income tax. Believe it or not, it's actually a higher standard. The company has to have some physical presence in the state, but states are getting more and more aggressive, so nexus is increasingly difficult to rely upon to avoid the obligation to collect sales tax in the destination state. So a question that may not be obvious is for Company A, its revenues from spam filtering may be subject to sales tax. And New York has taken a direct approach to this. They've declared that they believe that this is a type of software license. They think it's just a progression from the old days when shrink-wrap software was shipped, and then it was delivered electronically, and then there was the ASP model, and New York's saying they just don't see any difference. That's all the delivery of software. And so when you get to SaaS or cloud computing, New York figures that if the ultimate customer is using that cloud service, then in a way, indirectly, they're using software somehow, and there's a constructive delivery of software. Almost everybody says New York is wrong about that, but what do you do about it if they assess the tax? You know, it's going to be years before that's resolved, and you're not likely to go to court and spend the kind of money to fight it until that's resolved. Some states, I've listed some here, have tax on information and or data processing services. And so if Company A or Company B are providing these services, these cloud-based services, and that's considered to be an information service or data processing, those services would fall within the sales tax rules of these states. Now, these states recognize the difficulty in applying this tax in the cloud environment, as we were saying earlier, in part because it's difficult even to determine where the users are, even for Company A in a B2B environment. The customer of Company A has got employees all over the place, and certainly Company B, which is providing a B2C service with users going in and making reservations for gourmet meals, it's difficult to know even where these people are. So there are exemptions that are fairly useful in some of the major states. New York and Texas, for example, have sensible exemptions that may apply for cloud computing companies, and they should be reviewed carefully. Some other states are more problematic, like Connecticut, Ohio, Washington, and D.C. If the cloud-based services are considered to be pure services, then they generally are not taxable because sales and use tax only applies to the transfer of tangible personal property. There are, however, a few states that apply a broad-based sales and use tax to services, including Washington, New Mexico, and Hawaii, and a few other places. Now, one thing to consider is, in particular, in the B2B environment, Company A, which is providing its services in the form of spam filtering, what if Company A's customer was a telecom carrier that was bundling this spam service in its own, cell phone service? In that case, Company A would be selling its services to a reseller, the carrier, and it may be possible for the carrier to provide a resale exemption certificate to Company A such that Company A does not have to charge sales tax on those services. However, the resale exemption rules in most states are not written very clearly to apply to services, the resale of services. And part of the reason for that is if you look at a manufacturer that would, in fact, use a resale exemption regularly, let's take, say, Boeing. Boeing would buy aluminum, or I guess carbon fiber nowadays, and they provide a resale certificate to the supplier of those materials because Boeing's going to resell the airplane, and those materials are incorporated into the product. But if Boeing is buying the services of an engineer, a consulting firm, then it's more difficult to show that those services are incorporated into their final product, and so the states generally are hesitant to allow resale exemptions for the resale of services. So that's something to watch out for. And the last bullet point here in 14, again, to reiterate, we may not know where the customers are. Some of the states allow for what's called multiple point of use exemptions. Texas is a good one there. You can get a certificate from your customer, from your business customer in Texas that says that they are going to determine where their users are located, their employees in the case of Company A, and that removes the obligation to collect tax on the part of the seller.
Okay, turning to slide 15, I suppose that Company B is going to have the same sales tax issue as Company A, and that is whether its fees are taxable.
That's right, but here's something that is hidden another layer down in this morass of sales and use tax. Supposing the state, which most of them do, apply sales tax to restaurant bills, well, would that tax apply to the gourmet meals served by the host in his house? Now, it may be illegal for the host to do this because they haven't been inspected by the food inspectors and so on, but it's still a taxable transaction. So that host is supposed to charge sales tax on that transaction. The hosts probably don't know that. They don't have a mechanism to do it. And Company B, which is providing this online service, may not have that built into their systems, to add the tax. So the question then becomes whether Company B is some kind of an agent for the host and is responsible for collecting the tax on the actual meal charge. So there could be a tax on the underlying transaction, not just the transaction fee, and Company B may find themselves on the hook for that tax. If that is the case, then how do you measure the tax? Remember that Company B, in our example, is charging a fee to the guest, and they're remitting the net amount to the host. When you look at the rules in each state, in each city and county, they define what the taxable base is. And remember what we said earlier, the incidence of the tax is separate from the measure of the tax. So you have to read carefully as to what is actually being taxed. Is the tax on the providing of a meal, or is the tax on handling a transaction that results in somebody else providing a meal? These statutes actually can be written that way, and that will define whether Company B is a taxable party. The measure of the tax then hinges on whether Company B is really selling something that's taxable, and it also can hinge on whether the statute, for example, might say the measure of the tax is the gross amount paid by the patron of the restaurant, in which case the gross amount received by Company B, including its fee, would be included in the tax base. On the other hand, the statute might say the taxable amount is the amount received by the restaurant. So then the net amount would be taxable. So these are the kinds of issues that you get into when the underlying transaction may be subject to tax, particularly if it's one of these services.
And just to pause on this for a minute, we're using an example of gourmet meals through homes, and I know there are companies doing this now, but really these principles apply pretty broadly because there are a lot of companies doing things like that are acting as an intermediary between the sale of tangible property that's probably subject to sales tax and the consumer or and the business.
Yeah, that's right, and that's the big Amazon issue, and we see that for taxi cabs and accommodation and many different arenas. Okay, this slide is a little bit difficult to see, and the color coding isn't very helpful, but I thought I'd shock everybody into waking up and paying more attention here. The green states have a tax on cloud computing under Department of Revenue rulings, and the gray or light blue states actually have legislation applying the tax, and it is the black states here on the map that have not yet stated whether they're going to tax these types of transactions or have stated that they're not going to tax the transactions. And you'll note that California is a pretty major state in that regard. But there's a lot of other states that do apply the tax to cloud computing. That would be the ones in the gray, or the light blue color and the green here. Okay, is there any relief in sight to these sales tax challenges? Well, everybody's probably heard about the Internet Tax Freedom Act, which provides some protections. There's also a attempt by the states to get together and to come up with common definitions of what's taxable and where it's taxable. This is called the Streamlined Sales and Use Tax Initiative, and several states have signed up for this, which will greatly simplify it. On the other hand, states are converging on a very broad concept of nexus, which requires companies to collect sales taxes. They use concepts like economic nexus, merely having enough revenue in a state. For example, in Washington, if you have $500,000 of revenues in the state, even if you don't have any other presence there, they're claiming that you have economic nexus, and you could be subject to some of their taxes, not all of them. It still takes some physical presence, some minimal physical presence in order to have sales tax exposure, but states are very much expanding their concept of nexus. They're also expanding their concept of what's taxable in cloud computing, as we saw from New York, which treats a user who accesses a cloud service as constructively receiving the delivery of software. I suppose the silver lining on this is to consider that we know where we are, we know where this is going. There's an expanded nexus standard, and that's increasingly going to be difficult to use as a shield, and states are increasingly going to grab this as a sort of source of tax, so one may as well take a strategic approach to it and consider whether you might be able to help your customers, because they may want you to charge tax to avoid the hassles they have if they have to self-assess the use tax. So, and you may find, let's say in Company B's example, that the hosts that are providing these gourmet meals at homes would rather not deal with taxes at all, and they would welcome an increase of 8% of the cost of their meals for the sake of not having to take care of all these state sales taxes. So you could turn it into an actual competitive advantage as opposed to being a competitive disadvantage if the sales tax applies. Okay, a couple other surprises. Slide 18, the first bullet here is something for providers mostly of cloud computing services to consider. Telecom taxes on bandwidth are often, and I mean that literally, are often at the wrong rate in the wrong jurisdiction. These large telecoms, believe it or not, don't know exactly where you are in terms of the lines drawn by the cities for the city excise taxes and sales taxes. You might be literally on the wrong side of the street, or your data transmission may go through a switch that's in the wrong location, and it doesn't take much since a U.S. Supreme Court decision out of Illinois, Goldberg versus Sweet, that held that transmission can be taxed. So that's something to take a look at and see if you think that you're getting charged the right telecom taxes. Also, we talked about gross receipts taxes very briefly earlier. Washington has a B&O tax. So those are taxes payable by companies in addition to sales tax. And then there's gotcha taxes, like a Chicago lease tax. This is a rather bizarre tax on the lease of equipment, and the tax also covers certain software. So if you have software loaded up on servers there, it may be a tax on having that in Chicago, seemingly a counterproductive tax for them. Okay, international.
All right, one of my favorite topics.
It becomes simple now, I guess, right?
Compared to the state tax issues, it sort of does. Although, you know, we've always had somewhat the same tension in federal taxation of international transactions as we have in multi-state tax, and that is that business keeps changing, and the law and the regulations never seem to keep up. And as we'll get into here, we're dealing with some regulations that are more than 50 years old that apply to some of these business processes, and it's sometimes a little bit hard to understand which should apply and how it applies.
What I think I'd like to do here is jump through these slides fairly quickly. There are some key points you see on slide 19, and I want to leave enough time to get to value-added tax and another sort of hidden tax relating to 1099 filings, and hope have some time at the end for questions. So I'm going to go through this with apologies fairly quickly. One question is whether, like in the state arena, the company has created taxable presence in a country, in a foreign country, by using cloud service capacity in that country. The language used is a permanent establishment in a country, or PE. So that's immediately something to think about. Are you creating a PE? The upshot is if a U.S. company uses data capacity and servers in a foreign country, the U.S. company itself may have to pay foreign taxes because of having established a PE there. A PE in the cloud, does cloud computing create PE? Generally not, but it's something to take a look at. That's a growing concern. And it could be that having servers there that operate by themselves automatically might be enough activity that they could create a PE. But again, it's not a major concern at this point. It's just something, you know, to be aware of. Another key area is this whole issue of transfer pricing. And essentially on slide 22 here, first bullet, this is what CFOs need to know. The company tax rate is driven by where your profits land. And if profits land in a high tax jurisdiction, and there are a lot of jurisdictions out there with higher taxes than the U.S., then you're going to end up paying higher taxes. And of course, the highest tax rates are in which countries? The countries where the markets are, because they can get away with it. So if you have a company and maybe you're set up through a foreign subsidiary, that foreign subsidiary is going to pay taxes in its home country. If it's using the cloud to provide services, then it's possible that that foreign subsidiary would have to report a fair amount of profit to its home country. So the better tax planning internationally, this is the third bullet on slide 22, the better tax planning is, let's strip down the functions of our foreign subs, at least those in high tax jurisdictions, so that they don't do much. They're limited risk sales and support organizations. So you have to be careful that if your foreign subsidiaries are actually running the service and generating income, that they're booking as top-line revenue and they're outwardly facing to customers and they're managing the cloud services that are being provided. You may find that those countries where those subsidiaries are located are going to require you to report a fair amount of profit in those countries, and it's going to increase the worldwide taxes. So you have to be careful about what those foreign subsidiaries are doing. The fourth bullet on the slide illustrates the issue. If cloud computing is the basis upon which you're generating income, where's that income earned? Is it where you develop the code base? Is it where the services are managed, which could be the headquarters company? Is it where the data centers are, and where are they? Or is it where the customers are located? And B2B and B2C have different profiles in this regard. So again, the standard approach is to strip down the subsidiaries and have them just be limited risk sales and support entities. Slide 23. So one strategy is to get those profits out of those high tax jurisdictions, but you don't want to report on that income back to the U.S. So what do you do with your worldwide profits ex-U.S. if you don't want those profits to land in individual subsidiaries in high tax jurisdictions, but you don't want to pay tax back in the U.S. on your foreign profits? Typically, you set up what's called a base company, which provides the cloud services and generates all the income, and ideally you put it in a lower tax country. But be careful. You've heard a lot about companies that are setting up structures, Dutch sandwiches and so on, and Irish structures and through the Caribbean and so forth to get a zero tax rate. That is going to be becoming increasingly hazardous, as you've seen in the news accounts. Some fairly large companies have been absolutely hammered by UK and France and other countries for hiding profits in these zero tax jurisdictions. So my advice is don't get too greedy. Another key point here, fourth bullet on this slide 23, is you must have substantial presence and actually earn profits in the base company, wherever you set that up. So if you set up your company in Singapore or Ireland as a standalone company, you can effectively move most of your worldwide ex-US profits into that base company, pay your tax at 12 to 17% there, and keep it simple. And then all your other operating subs are just stripped down and have very little functions to attract profits. Next bullet, though, you know, how do you do that with a cloud services company? Here's where the cloud computing aspect of this business makes it difficult. If you go back to Microsoft, look how easy we had it back in those days. We could just duplicate the disks in Ireland. We shipped off a copy of DOS over there back in the day. And, you know, we could say, sure, we earned the profits in Ireland. We were duping the disk. The DOS was owned by an Irish sub for worldwide rights, and we shipped it out from there. But how do you do that in cloud computing? Well, the last bullet here suggests that you concentrate on putting management in the base company and make sure that that management is at a level where they're making risk decisions for the company. In other words, if they make the wrong decision on some key market or some technology development, that it's going to cost the company. So you want to have significant people in this base company. Again, it is very difficult to even determine where the profits are earned when we're talking about cloud computing companies. This also explains why the choice of jurisdiction for base companies is likely to be a place like the Netherlands, Ireland, or Singapore, rather than the Isle of Man or Luxembourg, which are generally much more favorable tax-wise, but how are you going to get some VP to live there? You know, it's, I know somebody that's lived in Luxembourg for years, and he enjoys it, but not many people want to go there. So you have to pick your country where you can actually set up shop and has low tax rates.
You know, Dave, as the token business lawyer in the room, I will add that documentation is important here. And not only should you have written intercompany agreements that very clearly reflect this allocation of function and risk, but the companies should act in compliance with those agreements. In other words, the document should affect the reality, because it's almost as bad, well, I say it's worse to not have anything, but it's a small step up if you have documents that aren't quite accurate, because once we get into a controversy, the documents are only as credible as they are realistic.
Yeah, not only that, being the accountant in the room, every audit I've been through where an international agent from the IRS came in, he wanted to see our entries. He wanted to see intercompany accounts cleared out. And he kept, they'd hammer every time on, show me the accounting debits and credits, and so we'd pile up all kinds of account reconciliations. And he was, in a way, hesitant to take on the technical issues because, you know, they're so complicated, and they knew we had developed our facts very well. They just wanted to catch us on not doing our, literally, the bookkeeping and the accounting correctly. So that's really important. Follow the script, in other words. Okay, Subpart F, what's that? I think we'll move forward quickly and just kind of skip this. This is basically is that you can read the first bullet here on slide 24. The U.S. does not tax foreign subsidiaries until the profits are brought back to the U.S. That's called deferral of U.S. tax. But the U.S. in certain circumstances does in fact tax in the U.S. foreign subsidiaries' profits under the so-called Subpart F rules. And cloud computing makes that very complicated indeed. I think what you should do is just go to the last bullet on slide 25 and talk with your law firm, your tax lawyer, and your CPA firm are your best friends here. These are hyper complicated areas, and I typically myself bring in outside experts on these Subpart F issues. They can be dealt with, but you really need to be careful going into it. All right, let's talk about VAT. Okay, VAT applies to goods and services, regardless of whether cloud services are treated as software licenses or pure services, but the rate of tax in the country where the tax is paid to will differ depending on whether the cloud services are software license or pure service. Let's think about Company A and Company B. Again, Company A is a B2B company that provides a spam filtering service, and it charges a fee for that. And it's charging a fee for the underlying service it's providing. That's absolutely subject to VAT. But we'll talk about it in a minute because Company A may not have to collect VAT. Company B also gets a service fee, remember, from the guest going in and getting the gourmet meal. That fee is subject to VAT, but also with respect to Company B, which is a B2C company, there's VAT on the sale of the gourmet meal. Remember we talked about sales tax on the meal earlier. Well, Company B's got more complications than Company A in this respect because there is VAT on the underlying gourmet meal. We're going to talk about who's responsible for what in just a few minutes. There are exemptions for financial and insurance services which are broader than you think. If either Company A or Company B provides guarantees, or if they handle the payment processing, which they certainly do in some respects, they may be able to wedge themselves into these exemptions. There's also special rules for intermediaries such as travel companies that might apply, and that might apply to Company B. Okay, countries with VAT type taxes, you can see are in black here, and it's just about everywhere except the U.S. and Greenland. There's that Iceland, or both. Okay, VAT obligation. The rate of tax and the country to which the VAT is paid depends on where the service is supplied to the users. For B2B transactions, generally clear where the business customer is located. But, very important point, slide 28, third bullet, B2B transactions are self-charged. That is to say, a business customer of the taxpayer is supposed to self-charge the VAT on its purchases. So Company A does not have to charge VAT to its business customers. The trick is, how do you prove it's a business customer? Generally not a problem, but sometimes that can be. Okay, B2C situations. This is our second company, Company B, which provides the the network online marketplace for gourmet meals. Where does the customer receive the benefit of a cloud-delivered service? Supposing the guest makes the reservation for the gourmet meal when they're at home in London, and they actually live in Brighton, and the reservation is for a place in Paris. I mean, where is the benefit received by that guest? It's difficult to nail that down. When I was with an online music company, we were in the very early stages of this, and we were delivering music electronically. This is in the pre-iPad days, and we had to determine where the benefit was received, and it was impossible to tell. Fortunately, there's something called the Electronically Delivered Service Classification, which is an effort by the European Union member states to provide a simplified method for companies that are selling using the cloud, selling services using the cloud, to determine where that benefit is received. And as you can see, the third bullet here in the slide 29, it's the residence of the consumer. That's where you determine the tax rate in the country to remit to. Generally, there are exceptions to that, but that's essentially where you fall. Additionally, its simplification, you can use what's called single point of registration for ESS, meaning that a company can register in a single country, at least for now, that's possible, and can file a single VAT tax form. So if you have, in our case, Company B that is providing this marketplace for gourmet meals, they would determine where's the residence of the consumer that they charge the fee to. There is VAT on that fee they charge the guest, and that VAT is determined at the tax rate for the country of the residence of that guest, and all of that VAT is collectively then reported on a spreadsheet to one country of registration if you choose to go that way, and then that country remits those VAT taxes out to all those other member states. Oftentimes what you do is you pick a country that's matching up with your international tax structure. If you set up your foreign-based company in the Netherlands, obviously you'd use the Netherlands for your single point of registration for ESS. Some companies have tried to achieve an even more favorable result by, you can engineer yourself into, at least for the time being till the end of 2014, that the VAT rate in an ESS transaction is set in your registration country. If you pick a single point of registration and register there, you can set it up in such a way that you use just that country's VAT rate. So obviously then the plan would be to set up your single point of registration in the lowest VAT jurisdiction you can find. This is Advantage Luxembourg. And you can then pay VAT taxes at the Luxembourg rate on your ESS fees that you generate, and achieve a lower VAT rate, which gives you a competitive advantage, at least until the end of 2014, when those rules are going to change. All right. One thing to think about then, and I'm sure everybody's wondering whether Company B is liable for VAT on the meal charge. So whoever's hosting this mythical meal in Paris, in my example, is supposed to charge VAT on the meal. Now, it's a little awkward when you show up for your gourmet meal at somebody's house for them to hand you a bill for the tax, although that does happen in other contexts, like staying in somebody's apartment. But that tax does have to be collected and remitted by the host in most cases. And the question is, whether Company B, as the intermediary, is liable to collect that VAT tax, similar to what we talked about in the U.S. with sales and use taxes. The answer is no. So there is not what we call joint and several liability on the part of the B2C provider, Company B in our example, for the VAT on the meal charge. They do, however, have to see to it that VAT is collected and remitted on their fee that they charge to the guest. One other thing, this is just a little interesting spin on it that you can see. Let's say that the guest, in my example, in London, who's making this reservation for the gourmet meal, is on a business trip to Paris, and this is a business meal. In that case, it's a B2B transaction, and therefore there's supposed to be the B2B rules, which means there would not normally be the VAT on the fee charged to that guest. So you can run into all kinds of variations as to whether a guest is subject to tax. And confusingly, when you get into this and talk with your tax advisors about it, confusingly, a business in Europe, which is supposed to self-charge the tax, and therefore you do not have to charge tax to them as a company, that's called a taxable customer. The one that you do not charge tax to is a taxable customer. And if it's a consumer on a B2C transaction where you are to charge tax to them, they're called, you guessed it, a non-taxable customer. So it's the exact opposite. And I think that was a conspiracy to keep this little club small for just special VAT service providers.
And you wonder why people hate tax lawyers.
Yeah. Okay, let's go on then. Totally different area now for something completely different, if this didn't seem like Monty Python enough. The 1099 tax trap. Everybody knows about 1099s that have to be issued, 1099 miscellaneous for payments for more than $600. And in this case, we might think about Company B, which is, again, the marketplace for gourmet meals. I'm on slide 31 here. So intermediaries who handle payments might have to issue 1099-K, which is a different kind of 1099. There are very high thresholds for 1099-K. These are new rules that came in 2011. And these higher thresholds mean that 1099-Ks only have to be issued in the case of very large payment transactions. It is not at all clear whether a company that handles payments as part of its other business, like Company B here, is subject to the 1099-K rules. The 1099-K rules were designed to ensnare eBay and companies like that handle pure payment processing. But the language is a masterpiece of obfuscation, and it could be that Company B is subject to the 1099 rules because it's handling payments. There are rules that say if 1099-K type filing rules apply, then the 1099 miscellaneous rules do not apply. But that's very much an uncertain area. And this is quite important because if one were to conclude that the higher thresholds that are applicable to Forms 1099-K apply to our Company B, then Company B might not be collecting all the tax ID numbers it should have, and might not be collecting all the W-8 forms from its offshore customers, in which case, if they guessed wrong, there could be backup withholding on the underlying transactions at 28 or 30% of the actual underlying transaction. So Company B might be on the hook for 28 or 30% of the underlying meal charges, even though their fee was a very small fraction of that they actually collected. So that's something to be very careful of, and it's quite an uncertain area these days.
And I would add to that that there just simply is not enough guidance under the 1099 rules to get a lot of definite answers. We find ourselves extrapolating by analogy a lot of times under some of these new business models. So 1099 issues are more difficult than you might think.
Yeah, we have a flow chart that one of the big four firms put together, and it's printed out on 14-inch high by 30-inch wide paper, and it's 3 pages long, and one flows to the other. So all you want to know about it. Reporting obligations. We're getting near the end here. Slide 32. Financial accounting reserves for tax exposures are important. This is where CFOs go immediately when you start talking about it. Tax planning and all the uncertainties we've talked about here today, and the lack of answers we've given, because this is more an issues awareness session. They create uncertainties, and you have to, at the end of the day, decide what kind of liabilities you need on your books. As most accountants are aware anyway, the standard for booking a reserve for income-based taxes is more likely than not, was there a liability? Here's the citation to the accounting literature, ASC 540. For non-income taxes, what we call direct taxes, sales use, VAT, and so on, there has to be a probable liability, which is more like 75% likely before you book it. But if there's a reasonable possibility of a direct tax, like a sales tax or a VAT, that doesn't rise to the level of 75%, you probably need a disclosure in your footnotes. There's also going to be tax return disclosures. One thing to think about is if you enter into what's called a cost-sharing arrangement. We didn't really talk about that, but that's one of the underlying techniques for managing your offshore profitability and getting the profits from foreign markets outside the U.S. You enter into these relationships with your foreign subsidiaries that have to be documented, as Roger correctly pointed out, with copious contracts, but you also have to disclose to the IRS that you're doing that. And those to schedule UTP, uncertain tax positions, that may have to be attached to a tax return. So watch out for your reporting obligations. Okay, to recap, this goes back to an earlier slide. The complications arise, again, because the services are not tied to the delivery of tangible property. And you should ask yourself 3 factual questions when you're looking at your business and then apply the tax rules. And the questions are laid out here, as you can see from what we said earlier. And the cloud computing traps that we mentioned are all summarized quickly here. The state taxes, not only nexus and taxability, but attracting income to the state by having a cloud-based there. Same way in the foreign arena. It is hazardous because the income moves around and it's hard to say where it actually is earned. The Subpart F rules we didn't talk about too much, but that's a danger area. VAT, the 1099 reporting, and the disclosures. So with that, I don't know if we have any
Dave,
comments or questions.
We have a question. Somebody asked whether, going back to the beginning, whether you could end up paying taxes on the same income in 2 states, or in fact in 2 countries for that matter. Can you address that briefly in the last 2 minutes we have left?
Yeah, you know, you could have, from an income tax perspective in the U.S., you might have income sourced to one state because the servers are there, and that very same income is sourced to another state because that's where the customers are located. And that would be, of course, double taxation, and there's really no credits. On the other hand, you might have no tax. If you have your servers in a state that sources income based on where the markets are, you're not going to pay tax to that state based on the presence of your servers. And then to the extent you have customers in states that have the reverse image, that apply tax where the servers are located, if you have your customers but no servers there, you may have no tax. So it's actually a combination of double tax and no tax.
Right. And you sort of hit on one of the key linchpins of state tax planning and the establishment of things like intangible holding companies and putting process. And probably one of the biggest reasons we're hearing that huge sucking sounds is companies move from California to Nevada. You know, on the federal side, though, it's worth mentioning that, yes, you could be double taxed as well. The United States has entered into income tax treaties with virtually every industrialized nation for the avoidance of double taxation, which basically just cedes primary taxing jurisdiction to one country or another, meaning that that country can tax the income and the U.S. won't. In some cases, what you end up with is 2 countries taxing the income, but the U.S. giving a credit. But it's an imperfect solution because it's most often the case that a company doesn't have enough, can't use all of the credits for one reason or another. And that's a whole other hour of discussion. So the last question is, where do we get the slides? On the last page of Dave's outline, you'll find Dave's contact information. You can email or call Dave. We'll also have this webinar recorded and up on our site. both as a podcast as well as listed on the Royse University site, and the slides will also be available through that site. So with that, I'd like to thank Dave for being here today. This was an extremely informative, action-packed, information-packed session. So thank you, Dave, for doing this, and I'd like to thank you folks in the audience.